Mike Wilson on a rolling recovery rather than rolling recessions.
Stanley, CIO and Chief U.S. Equity, basing some of your forecast. You're not just like looking at momentum in stocks maybe continuing to go up. You're trying to decide whether there's a recession risk. You're trying to decide whether, at this point, Bullard just said it, you think the recession risk is behind us and we're reaccelerating now. The economy is reaccelerating already.
Yeah, I mean, I think forecasting stock markets is as hard as coming up with gigawatts or gigawatts. Okay, trust me.
Well, you're not even doing stock markets. You're doing the economy and the Fed.
Yeah, I mean,
they can't do it.
Well, I mean, look, it's difficult, right? We're trying to live 6 months in the future, and I think the market does live 6 months in the future, as we've said many, many times. And our thesis for the last 2 or 3 years has been very consistent. We think we've been in a rolling recession for 3 years, and we've documented this.
This is a very Cathy Woodian argument so far. Just basically the sectors going through a recession. I mean, chip stocks, for example, end of 2022 were in a recession, essentially. That's back when I sent out an alert to course members and bought a bunch of NVIDIA shares, and still hold those today. So it's been a good ride.
This in quite a bit of detail. The last couple of weeks, we've actually gotten more information around the job revisions. Not just the big one that we get the 911,000, but also the 2-month payrolls. And we've done some pretty interesting analysis there that shows very clearly that the trough of the labor cycle was in March, April, okay? Whether you're looking at job cuts or you're looking at
March and April for the trough. Really? I don't know about that. I don't know about that at all. I think he might be wrong about that. Hold on a second. Let's look at 27-week unemployed, which is typically a proxy for recession. And I'm not trying to be a bear here, but you're telling me that the trough was March and April for the labor market. I mean, maybe, like high is bad here, right? But we're way worse today than where we were then. So that's the 27-week unemployed number. And then if we look at St. Louis Fred, we do BLS jobs report, just how many jobs did we basically gain in non-farm payrolls. Let's go look at that. And we'll go to the change of thousands of people on a monthly basis. So the trough, I think I screwed up the chart here. Hold on one second here. Let's see. Yeah, no, this data goes all the way. Remember, you could always change this to change rather than the cumulative number. And then we're going to zoom in over here. There we go. Yeah, so he's saying March, April, May over here, trough. I don't know about that. I think it's more like, I mean, I guess if he's referring to June being May and May being April because of when they're reported, they were talking about the prior month. But we're basically going right back into that. So this is why we really need a strong September report to say that we're not trending towards negative here. I mean, any technical analysis, fan, like we do every morning in the Alpha report, is going to tell you, hey, man, the trend here ain't your friend. So I don't know, man.
The payroll revisions, and that bottomed, okay, with the government recession in Doge, which is what we were waiting for. So that was all of our thesis for this year. So we feel pretty good. We have the right narrative now. The market, by the way, is our confirmation. The market figured this out at the exact same time. So that, like the old adage, trust but verify. We trust our analysis, but the market kind of verifies it.
I was going to ask you, if we went through a recession, why are we at new highs? But you said it didn't happen until the recession was already over.
That's right. Well, typically, remember, Joe, when the market always bottoms during a recession. It doesn't bottom when it's over, when it's obvious to everybody. Okay. Now the Fed's working on
the market bottomed at the end of 2002 to the beginning of 2003. That was kind of when the recession was at the end of the dot-com bubble. The market bottomed in February of 2009. Obviously, the greatest panic was in September of 2008 during the Lehman Brothers collapse. So I don't think the market bottomed, essentially for a while there. Of course, people were worried about a double dip recession for years after that, so that's possible. COVID recession's really hard to compare to. So I don't actually, I don't know, man. Usually the market bottoms when the Fed turns the money printer on. That's when the market bottoms, Mike Wilson.
Taking data, like always. By the way, that's not new either. This is not a unusual feature. We saw the same thing in 08. We saw the same thing in 01. Okay, we documented this. So,
but again, he's misleading the dates here. in my opinion. I mean, unless in 2002, at the end of it or the beginning of 2003, you thought you were in the depths of a recession, and that's how people felt. Maybe because unemployment usually lags, right? Like, unemployment didn't really peak until 2010, so it could take a while.
This is very apropos for how it usually works. The one thing that's missing this time, it's different than 01 and 08, is the Fed is actually behind the curve more than they have been in other cycles because of that lagging labor data, which we think will catch.
Okay, he's actually now making the argument, that's interesting, that I think what he's about to say is the Fed is behind the curve. That is, usually the Fed cuts when the market bottoms, but the market bottomed and now the Fed is cutting years later because they're behind the curve in a bullish way, not in a bearish way. Now that is an interesting argument I haven't heard before, that when labor market data is as crappy as it is, you've got Mike Wilson going, oh yeah, the Fed is actually behind the curve because of that lagging data, not to save the labor market, but on the upside. Oh, next thing you know, he's going to start talking about interest rate hikes. Well, this is a different perspective for sure.
Up in probably November when all those Doge employees who were let go have to file for unemployment insurance.
All right, so we're going to continue, even though we've already bottomed, we're going to continue to get some straggling bad numbers.
Right. So and then that once all that bad data goes away, then the Fed can basically hike again or stay aggressive. I think that's what he's implying here. This is a novel perspective.
Absolutely, that's the way it always works.
They're going to straggle in.
Interesting statistic, okay, which is the market, typically bottoms a year before the unemployment rate peaks. That's typical.
Why should?
Okay, that I agree with, because like you said with the 2009 to 2010 analogy, that I agree with. But the question is, like, our unemployment rate is not on a trend of peaking. Our unemployment rate has barely moved. So this is where I take issue with this as well. If we look at the unemployment rate over time, so I'm trying to jive with Morgan Stanley's Mike Wilson here because it sounds bullish, but look at this. Okay, in 2000, the unemployment rate, it looks like it peaked in June of 2003. Well, the market bottomed 6 months to a year before that, because you sort of had a double bottom. So 6 months to a year before that, kind of had the double bottom. Okay, so that's correct. I agree with Mike Wilson here. But look at what the unemployment rate did. It skyrocketed from 3.9% to 6.3%. We were up, what is that? 6.3 was at 2.5%. 6.3 minus 2.9, 3.4%. Right? So you got a 3.5 percentage point move in the unemployment rate. He talks about 2009 and 10. Yes, correct. The unemployment rate, kept skyrocketing, and it didn't peak until about a year after. Yeah, he's right. Like October of 2009, beginning of 2010 over here, you peak at 10%. But we went up from 5%. So you had a move over here of 3.4%, a move over here of 5%. What have we done right now on the unemployment rate? At most, we've gone from 3.4 to 4.3. We are up 0.9. So, if that's the worst it's going to be, great, that's fantastic. But I don't know that we've really had the unemployment cycle flush out yet. It would be very bullish if what Mike Wilson is saying is true. But I think he's so shell-shocked that he was a bear during most of the Nike swoosh recovery. 2022, 23, early 24. He was a bear during almost the entire Nike swoosh where we're like, here's the resident bear again. Nike swoosh keeps booming. And I think now he's afraid to be considered a bear. Because I don't know.
Should the Fed be cutting now then? They should be raising.
Well, because there are other reasons they're cutting. Okay, first of all, we do need to cut because in order to get a full recovery, right, the rolling recovery now, we need rates lowered. One of the reasons why we've had
This is so weird. On one hand, he's telling us, yeah, the Fed's actually behind the curve because we're just going to get some straggling bad data and then the economy is fine. But then on the other hand, he's saying the economy is actually not fine because the Fed needs to cut more. Bro, what are you smoking?
Tepid, kind of economy in the private sectors because rates are too high for most businesses, particularly small businesses and consumers. So they do need to cut rates. The question is,
so his nuance is, well, the recovery should be even stronger. All right.
How much are they going to cut? And that's why we haven't seen the full rotation yet to the early cycle, small cap, low quality parts of the market. Okay, so I believe that last week was sort of a sell the news event because the Fed is sort of dragging its feet they cut 25, and the market really wants or expects, or is priced for, more importantly, for something more aggressive. So we have this window now for probably the next 6 weeks or so where we think the market is at risk of this tension between the Fed being kind of behind its own curve and the bond market. And
I think the next 6 weeks matter because you have a government shutdown on October 1st, which is almost always a buy the dip opportunity. But it coincides this time with September job numbers, which are expected to come in at 42,000, which would be great because it would be finally like we'd be picking up, and then we could agree with this rolling recovery argument. We'll pick up again. That comes out on October 3rd. ADP employment report, that comes out on the 1st, and those numbers are expected to be 50,000, in line with the 54 last month. So those numbers could be good and could reiterate this, okay, rolling recovery, can normalize rates, but the next 6 weeks could be really funky, heavily in part because if we get bad numbers and you have a government shutdown, the Fed's going to be behind the curve, not in a bullish manner, but in a bearish manner.
the equity market's really wanting or needing now a more aggressive Fed path.
But the background, your whole overriding theme is that we're early cycle. It isn't early cycle.
Yeah. That's what, like, I appreciate the CNBC guy's confusion. Like, wait. You're saying we should cut, but then you're saying we're early cycle. It's just we should have a stronger early cycle.
If you're patient for the next 6 weeks, shouldn't you be buying stocks here then if we're early cycle? I mean, are you telling people right now we're early cycle and it could be the beginning of a multi-year period?
Yeah, he's doubling down on that. That's what he's saying. Oh, man. Okay, all right.
It's exactly our call. We said very clearly that, April was an end of a bear market. That was a liberation
Sorry, I got to get my stand goal in. Health is very important.
week was the final piece of bad news you typically get at the end of a major bear market. And by the way, just to be clear, the average stock was down 35% between July or April of 24.
Wait. He's saying the final bad news is basically going to be the Doge layoffs. That's going to be the final set of bad data. Man, I hope so. Because people are just going to adjust those numbers. I get asked almost daily. Not about the balance sheet, although...
Kevin is much more interested than most people, by the way, in the balance sheet.
No, I get asked almost daily about, but Kevin, the Doge job losses are going to come in the next reports. Yes, but people are just going to adjust those away, right? So my point is, they're going to look and say, okay, if we had negative 50,000 Doge numbers show up in the reports, they're just going to add those back in. So if the report comes in at 0 and it's negative 50 from Doge, people are going to add that back in and go, okay, well, absent the Doge, one-time effect, we actually grew at 50,000 jobs. So I don't know, man. Let me finish my stand goal.
In April of 25. That's a proper bear market. So the new bull market began in April, and now it's evolving, and the stock market's ahead of kind of the data, as it typically is. We've seen, by the way, just because small caps and low quality early cycle stocks haven't outperformed, they have gone up in absolute terms significantly. So the market is telling us that that thesis is correct for now, and the risk of that is that the Fed stays behind the curve longer than the market expects, and we have a little digestion here, which could be a meaningful correction in the next 6 weeks. We'll see how it goes, but either way, that doesn't change our thesis that the early cycle rolling recovery has begun.
I can see going against the consensus, but
on one hand, we are potentially going to have a big correction in the next 6 weeks, he says. I get it, because you've got this data coming out and stuff. I kind of agree that we're sensitive to something like, a little oopsie-doopsie over the next 6 weeks anyway because of the jobs numbers and government shutdown coinciding. Government shutdown alone, I think, is the greatest buy the dip opportunity ever because this is the biggest fugazi ever. But he's basically saying, Liberation Day, that was the bottom. That was the recession. Okay. I mean, that's a bullish thing to say. But, dude, a recession is pricing in massive job loss. That's not what we got at Liberation Day. Liberation Day was trying to price in what would happen to company margins, not layoffs. So when I look at the job numbers, I see much more weakening and much more, devastating data than I think Mike Wilson is giving credit here for. And I think that's where the best way, to throw a banner up here is not just to say that you can get a 2% bonus on balance transfers at Webull, which is obviously a
paid promotion.
But this, that you could get life insurance in as little as 5 minutes by going to meetkevin.com/life. I don't know. Interesting perspective here from him, but I'm not convinced that he's right. Because again, reconciling that to the bottom line, he's basically saying the bottom of the market was April, it's up from here, and even though we'll have some ups and downs, we are bullish going forward and buy stocks at these valuations is his point of view. And his argument is we're just going to have a slow beginning of a recovery, and the Fed should cut to sustain it more. And once we get rid of this leftover Doge data, we're good. Basically, he's saying the economy is going to magically go from this massive decline in adding jobs to a U-turn. So this will look like a giant half pipe, basically, and we'll have that U-shaped recovery in jobs. Okay, Mike Wilson, I don't know. Let me know what you think in the comments. It seems a little wild, in my opinion. A little wild, but okay, no problem.
I'm like a monkey song. I'm a believer.
Yeah.
Okay.
Like I'm in it. I'm just listening.
I don't even know if there's a first out in the first inning here. I mean, we're that early.
Well, speaking of AI,
Yeah.
I'm doing this one for you. NVIDIA.
Okay, go for it.
Gotta look at it today, pulling back a little bit, but surging on Monday. The company's investing a whopping $100 billion in OpenAI to support new data centers. OpenAI will deploy enough gigawatts of AI to power 8 million homes.
I don't
Yeah,
think
buddy.
there's a company in America who people talk more about than this company. I hear it all the time. I started following it 9 years ago because they were in the gaming and Bitcoin mining, and look what it's become. We know this.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.